Now next one is about the investment receipt model and related concept. Investment is the common parlance of means exchanges money for the return or profit and yield assets. Individual earning money can either invest his money will supplement his future. So if a certain part of income is set aside regularly for investment, his income will be grow constantly. And some things happen case of GDP growth rate, gross domestic product aggregate for final goods and services produced in an economy, and what kind of goods and services are produced, what happened to those goods. Obviously all kind of goods and services which are consumed are produced further. Some goods and services which is produced are exported only to consume so outside. Similarly, but or consumed India broadly, there are four widely used classification of GDP. Private consumption for the goods and services which are consumed. Investment is the new era, and government consumption it is the taken new tax and expenditure. Next, exports is if export more than imports than GDP like now. Included in private consumption category as the goods import either directly consumed or input of the goods. So deducting the imports in the part 4 only includes profit earned by the domestic trader. Consumption method is the consuming GDP. Alternate method is the income. Think of whole economy of the country, and whenever is the like consumption method is the for computing the GDP. An alternate method is for of income. So it's a person being sold by one person to others. So value of the total production is nothing but total income of different factors involved, like labor, material, capital, property. Like in labor we get wages, in material we get profits, in capital interest, in property we gets rents, and proprietor entrepreneur GDP equals to aggregate consumption of final goods produced and aggregate income all factor of production. So if you are just ordered a book from Flipkart 500, they your consumption is rate 500 and income of different factor is rice, supplier and paper and service. Now investment of green gross capital formation. So fixed capital formation, valuable and change in inventory. So note that macroeconomic investment only include the physical assets, it exclude the financial assets such as share and debenture for obvious reason. Transaction and financial assets are just transfer of ownership of underlying assets from one person to another. It doesn't result in value addition. So this is the investment or gross value formation. This includes the three category: fixed capital formation in investment, valuable change in inventory. So result into the any value addition or new capital formation. If you purchase share of some company, production capacity of economy remains same, and production in economy will change, its new physical assets is required. So avoid the confusion. Word capital formation is more than use the investment. In national account, meaning of the investment is the aggregate of this, and fixed capital formation refers to investment in building plants and material equipment. Valuable means investment by the household in the gold, precious metal, and there is disagreement classifying valuable and capital formation. Just short value doesn't result into any productivity peculiar character, but directive of United Nations provide the current classification, and with the currently like India where gold always huge demand the pushes the gross capital formation, and gold covers 1.5% of GDP. Under the inflationary pressure, people find safe investment gold instead of plant and machinery. This is so because as a history, price of gold is always expected to rise and faster than interest rate in the Indian economy. Further, inventory are the stock held by the business unsold end of the year. So increase the stock and end of the year increase investment. So three items like gross capital formation in GDP which is not consumed by people, and save investment in this respective asset. Beginning of the investment with yield of additional return to the GDP growth. Interesting thing is macroeconomic level saving, investment capital formation in case of an individual saving, and unless invest in saving in case of not considering any currency. So direct dealing with the money value different goods and services. goods and services consumed by the people, and saving 34% for GDP and apparently balanced investment and abroad. Another way is economy different between like saving and investment always equal to differentiate between export and imports and increase the decrease inventory. Any import increase domestic inventory and export decrease the same. So current account balance is difference between the import and the export invisible goods. So export are more it will be surplus, and if import are more it will be deficit. We can say investment equal to saving plus current account deficit. Investment equal to what we saved and what we have current account deficit. So now incremental capital output ratio, as investment increase we will addition to GDP which will in back in this incremental investment. Say ICOR is 40% additional investment will result into GDP growth 10%. So ICOR explain how much investment is needed in the economy in GDP 1% point. Additional investment will add to the current investment in economy and will produce the additional goods and services. Hence there are two sources of higher growth rates. One is increasing the productivity, another is promote the higher investment and lesser consumption. Consumption is equally important in provide the demand for the current productions. Good consumption create the demands and pulses price and products, and higher price signal for investment to invest the economy. If there is a good consumption, economy can draw appreciate amount of foreign investment, an economy which attract the investment all round. Now putting in things perspective, GDP grew the 4.7%. Economic service capital formation rate is yet 34%. ICOR remain the 4 and the capital formation is 35 to 36. Growth which explain 36 by 4 is 9%. China investment rate is 40 to 50%. So ICOR can rise higher than the Y despite capital formation is 34%, growth rate 4.5%. Further capital formation will valuable which is time amounted to 2.4% of GDP, and highest recent year reason for such a low growth, high investment and famous policy paralysis. Due to an environment and labor law, many ongoing projects halted and productivity of economy is unserved. Other issue were corruption, scandal of 2G and coal block, cancellation of block and spectrum license SC, when the SC consequently big project which already had long gestation periods, accumulating interest costs, and this case new investment at bay. This is how investment work in the macroeconomics. We have learned importance of the investment of the growth implicitly signify the social importance, and investment create job economy which further result increasing the saving consumption investment socialistic era and capacity to provide the jobs. Now expected to absorb the majority of human resources, private sector is weak and involved burdened by the government. We can verify the noticing the current fresh government further investment result increase the productive capacity, and this turn result pushing the down to the price. So we have suffered from below 1% growth. After independence we obviously opted for planned development. Planning has to consider the mean of development resources at the disposal of government. So they had to the chart preferences and pick out the sectors reaching the multiplying impacts of the economy at least cost, and there is target industry there were option for consumption goods industry and capital goods or small scale. Now Nehru Mahalanobis model growth was adopted and small investment was to be met, and these industry provide the resources base for consumption and goods industry, and of this overtime the build industrial base. Government backed PSU became a burden for economy. So LPG reforms which is private sector assume economy and government starting rolling back. Already industrial base was quite redundant, in infrastructure was a quite shape. Government instead addressing the problem and manufacturing focus on service. Manufacturing sector can only be performed only if there is sufficient supporting infrastructure. Power, road, ICOR is decreased. Service sector on the other hand specific requirement. Global internet revolution. Service sector is generally employment inelastic at all resulted jobless growth is 2 decades. It was realizing healthy manufacturing industry imperative for the inclusive growth, and this is example of China. It is per capita income is less than the India. So new investment model is private sector was instrumental while obviously private goods should be left alone. So private goods are those which are provided exclude consumers from the pricing power. For example, burger, train, fares, and consumer who don't want to avail service or who can't afford is excluded. Another characteristic of the private goods is that rivalry. This signifies that the private consumer on the being consumer are left less the other. In contrast, public goods are those in the exclusion of possible nor are they are rival. So law and order service by police in the public goods and services provided to whole society and consumption doesn't result in lesser availability of the. It is very hard for the private sector to provide public goods and there will be the pricing problem. Private sector work for profit and its case of may end the exploiting the consumer by overcharging them. Private sector doesn't legitimately demand money for the public service if the government collect tax for the provision of a wide array of public goods and service, but it is recommended time and again by the many committee that respective government should leave maximum work to non-private sector, and this was because government service were substantial and no corruption. Now government has evolved new methods of private sector involve the itself provision of public goods and service. Example telecom service BSNL is player for the airport highway. Government is this case or public private partnership public private partnership government statutory entity is a government owned entity for the provision of the public assets and public service investment being made management being undertaken by the private sector and specific period of time well defined allocation of risk between the private sector and public entity and private entity who is chosen on the basis of open competition bidding and performance linked to the payment conform to the specified and predetermined performance standards, and different PPP arrangement vary on the who undertaking finance designing constructing and custom and support the service. Apparently degree of involvement for the private sector's PPP projects not if PPP doesn't amount privatization not even partial involved for full retention responsible to the government for the providing service, and PPP is just a time bound contractual arrangement. PPP is for the build, operate, own, transfer, build, develop, operate, design, construct, manage, finance, and build, operate, lease, develop, operates, and wrap around additional build, operate, transfer, build, operate, transfer, build, lease, operate, transfer, build, transfer, operates. These are the PPP modalities. The private sector design, build, own, operate, manage asset with no obligation. Government these variant design. Finance operator scheme. The private sector buy lease exists from the government and renovate the moderate and expand it and the operates again no obligation to transfer around back to the government. The private sector design and build and operates it and transfer it to the government when operating contracts. Government policies for the PPP viable gap funding. The scheme aimed at the supporting infrastructure project that is economically justified but fall marginally short. Finally, viable support under the scheme is available only for the infrastructure project where private sector sponsors are selected through a process of competitive bidding. The total viable gap funding under this scheme will not exceed 20% of the project provided that the government stated entity that own project may, if so decided, provide additional grants of the project up to the limits of further 20% of total projects, and bid are made in the form of government support required. Bidding for the least government supports project funding can be provided by the both central and state government. India Infrastructure Finance Company is this government company created to provide a long-term finance to viable infrastructure projects and scheme for financing viable infrastructure projects. So the special purpose vehicle eligible for financial assistance from the IFCL, transportation, energy, water, sanitation, communication, social, commercial infrastructure, and public-private partnership. Infrastructure debt fund is the investment viable accelerate from the long-term debt sector, and IDF infrastructure debt fund is tasking the share of the outstanding commercial bank loan and sponsoring the non-banking financial company 70-30 ratio. 3P India is the latest budget finance ministry creation of institution 3P India corpus of 500 crore to provide the PPP plan. 3P India entity will examine the issue related to regulation, finance structure, management of contracts, stretch public-private partnership projects. Some recent announcement PPP is worth 4200 Jalmarg Ganga Highway and ultra modern solar plants and thermal plants. Under the recent past land acquisition PPP is the acquired land provided 70 landholders and budget gives the renewed focus to the PPP model. For by enthusiasm among the investors gradually main trusted the project's infrastructure, highway, electricity distribution, and project lingering the regulatory hurdles in macroeconomic situations. Capacity to invest the long gestation projects is PPP model like invest capital government hand. So 12 5-year plan targets 1 trillion investment, which expected to private sector, but there is a serious doubts capacity of private sectors and private sector expect to invest in projects and periods no unless getting some support. So corporate debt market underdeveloped India, so investor depend on bank capital market and bank can't lend the such long periods. Other commitment to assessment of basics interest, money mobilize, risk return calculation is there. So what are the problem we have? Political uncertainty, land acquisition, environment clearance, multiplicity of the regulations, public nature of work. They are under the supervision of scrutiny. Multiple independent regulators are there: CAIG, labor development, local boards, environment boards. Cost escalation, like last decades have the unprecedented inflation. This normally was expectation absence of flexibility in the pricing long term, like because of this it is not possible to account for the every exigency which may crop up in the future. Public activism is not avoided. There is the widespread public risk and cost of should be undertaken. Lack of exist options like low capacity in economy to exist. Investor government decide to scrutinize the investment and to provide the exit option. Pricing barriers are there, can't be delivered the charging cost plus profit and subsidized pricing hallmark of this service. This needs to be better coordination and investment over the giving remunerative deals, ensuring low price and quality provision. Flow project assessment, PPP project were undertaken economy, so that is time invested but influenced by the strong and excessive optimism. Energy projects is problem and potential. There cannot be any blanket policy for all of the sectors. Each needs to handle the case of case basis. There are the regional and sectoral variation, pricing, regulatory issue. So for planning commission board the concept from the overseas project ignoring to mold them in domestic situation. The investment economy can be done mainly government and private player. Player may be included